Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's 7:45 a.m. Eastern Time, Monday morning, May 5th. You'll have to excuse the quality of the video this morning. I'm in an apartment in New York City. We'll be back in Colorado tomorrow, having spent the bulk of last week in Boston, making a brief stop in Storrs, Connecticut, my homeland, and then on to New Jersey for the weekend. We've got a day of meetings here in New York, a Fox Business appearance with Charles Payne this afternoon, and then back to New York tomorrow morning. Our note this week was titled Capex and Confidence, as we looked at last week's advanced estimate of first quarter GDP and got the last of the regional Fed manufacturing surveys. We had a number of discussions about the implications for the tremendous hit we saw to capital spending plans through the implementation of President Trump's trade policy and how quickly that could potentially come back. So there were three parts to the note this week. The first one reviewed the employment report. It was titled Too Soon, which was also part of the title of our preview note, and about the only thing we got right with respect to the employment report was it was too soon to see the effect of the hit to business confidence in the employment data this month. But we did get softening wage growth right. So the inflation or the labor market is definitely not a source of inflation. That's how the Fed's been viewing things. And it still contains lots of risk, but we did not see it in this month's report. The bulk of the report really was about how integral a recovery in capital investment is to the equity market outlook, to our relatively bullish outlook, and just how that might unfold, integrating the longer term case for a capital spending boom, the cyclical case, and then just this impact of all of the policy changes that are taking place under the Trump administration. And then we finished up with a discussion about markets and whether we would resume the narrow tech-led advance or would get some broadening out of performance. So, as I mentioned, the labor market report was fairly strong. We would look through the establishment survey results. We got negative revisions. It was flattered by the birth death model. The job concentration by industry was fairly narrow. We got one of those big contributions from, call it government adjacent sectors like education and healthcare. And the ADP report was weak. So were it all about the establishment survey, we'd be looking straight through the report. But the household survey, which is generally very highly correlated with the Conference Board labor differential, was actually quite strong. It created 436,000 jobs. The labor force expanded by 518,000 jobs. We saw increases in participation for prime age workers, and unemployment fell by 660,000 jobs. That left the U3 unemployment rate virtually unchanged at 4.187% from 4.152. We expected this to increase to about 4.35 based on that Conference Board survey. And the U6 underemployment rate fell from 7.9 to 7.8. But recall 2 months ago, that went from 7.5 to 8. So it still remains a little bit elevated, but the work week was up a little bit. That was impressive as well. So the only thing really soft about that report were wages. We then moved into the long-term structural case for a capital spending boom, and talked about the China shock, the episodes in the 60s and 90s where we'd had supply-side tax reform, we had stable prices, and then we had capital spending booms. The stable price piece is going to be important for getting a real boom in capital spending over time. We then integrated reconciliation bill and how we don't believe that we're just extending current taxes policy. We heard that again from an equity strategist this morning who seemingly doesn't really understand what's going on there in terms of supply side corporate tax cuts. Maybe having studied economics in the early 80s, we're a little bit more cognizant of that stuff, but it's crucial to equity earnings and margins, profit margins and the like. So we do think that there is a possibility that if we can get the trade policy stuff settled, that we will have a sharp recovery, just a sharper recovery in capital spending plans as we had a hit over the last couple of months, and we can still get that second half recovery in capital spending, which would drive stock prices, margins, productivity, and all higher. But but the clock is ticking on all that, so we'll see how the reconciliation bill goes. For more details, become a full subscriber. This is Barry Knapp with Ironsides. Have a good week, everyone. Thank you.